Next, I'd like to introduce Ken Entenmann. Ken is the Chief Investment Officer and Chief Economist at NBT Bank. We're grateful to have Ken and NBT here today. NBT Bank, or the National Bank and Trust Company, is a 160-year-old banking institution started in Norwich, New York. I was getting to hear a little bit more about it today, in growth. NBT also has a location here in Portland, and as Craig mentioned earlier, Kim Twitchell's here today, and a volunteer on our board, and a board member here at MEREDA, and the regional president of NBT. We've asked Ken to speak because he is bringing an economic perspective from outside of the state of Maine. He follows and is informed by the national trends which help us during our conversations today. Ken has over 33 years of investment experience. In his current role, he oversees more than $6 billion in assets in trust, custody, retirement, institutional, and individual accounts. Welcome, Ken.
Well, good afternoon, everyone. It's great to be here. Really excited to have this opportunity. I want to thank Kim for inviting me up here. And I'm an economist, and I'm here to talk about the economy, and there's absolutely nothing going on, so I don't have much to say. Actually, I'm not going to talk a lot about housing because most of you are far more expert in housing than I am, so I'm going to talk about general economics and things that I think will impact housing. But before I start, I want to tell you that I grew up in the original affordable housing. Is this, we got my presentation going here? There we go, whoops, got to go back. So I grew up on Long Island. My father was a Nassau County policeman, and they moved from New York City out in Queens out to Long Island to a town called Williston Park. And I was there a couple of weeks ago visiting my mom, and in the local restaurant in my hometown, the village of Williston Park, the restaurant's name is Williston, pretty creative, was this poster from the housing development that occurred in 1926. So look at what it says. It was a $4,900 account with $400 down. The plot is 40 by 100 feet. That was affordable housing. It had 6 rooms, not really. There was a little baby room. Parents knocked down that wall. There were 2 bedrooms on the second floor, and that upper window you see was called the attic, and that's where my 2 brothers and I slept. In the details, it says it has hot and cold piping throughout the house. Not true, false advertising. We slept in the attic. There was no heat, and there was no air conditioning. We like to tease my mom, who's 85 years old, that we could report her to child abuse services right now because it was pretty damn cold, even on Long Island back in the day. But this is what affordable housing looked like. $4,900 in 1926. My parents moved in 1958. They paid $14,500 for the house. And talking to my mom about this, I was there last week, and I told her I was coming up here and I was going to use this poster, and she said she was mortified that she didn't think she was going to be able to pay the $87 a month mortgage. That's the original affordable housing. But think about it, $4,900 to $14,000 in about 40 years. Today, if my mom were to sell her house, it would go for $600,000. And what's more important, and I think more relevant to you folks here in Portland, because I think you're kind of suffering from this. One of my teammates, when I played at Cornell, his father was a New York City fireman. My father was a Nassau County cop. But he grew up in Port Jefferson, which is about 50 miles east of where I grew up. So I'm about 21 miles from the Midtown Tunnel. In the poster, it talks about being next to the Long Island Railroad Station, which is a big commuter line into the city. So this was a pretty attractive place. But now when you go back there, the home prices are inflated because there is a lack of supply. And the problem that a lot of the firms are having is the support staff, the paralegals at law firms, the police, the firemen, the sanitation workers can't afford to live in the community, so they live 60, 70 miles out on the east end of Long Island. And that was the original happiness home, the original affordable housing. So I want you to know I experienced it, and I'm still a little cold from sleeping in the attic all those years. So I think we have this should we stay or should we go environment. So I went to college in the 80s. Note, this is not a picture from Craig's high school yearbook. No, not from his high school year. This is the Clash. And, I was thinking it's kind of, this is a very interesting economy because there are people who are calling for doom and a deep recession, and people are saying we're not even in a recession, we're not going to have one. And if you're Jay Powell at the Federal Reserve, you're kind of in this should I stay or should I go moment. We've raised interest rates. We'll talk about this in more detail. But if you look at the song, and I listened to the song, and I had to look up the lyrics, so should I stay or should I go now? If I go, there could be trouble. If I stay, there could be double. Doesn't that kind of sound like Jay Powell's predicament? Should he continue raising rates to fight inflation in face of what looks to be a slowing economy? That's really challenging. I will tell you, being a college student from the 80s, the Clash, that is a picture of the Clash, was a hot book. You couldn't go to a college party without hearing it. And listening to this song, preparing for this, I think it was the first time I ever listened to the song sober. Right? I mean, who listens to the Clash unless you're at a party? So what I'm going to do is we're going to talk about the economy. Are we in a recession? Are we not? I would argue that maybe we have to redefine recession because with the start of the growth of our economy, the diversification of our economy, the diversification of the geographic regions, I don't know that recession is a one-size-fits-all. If you go back to the 1800s, 90-something% of economic activity was agriculture. And if agriculture went into recession, everybody was in recession. If you go to the 1950s, a super large percentage of economic activity was manufacturing, and when there was recession, everybody was in recession. Well, that's just not true anymore because our economy is so more diverse. And what's happening here in Portland looks absolutely nothing like what's going on in San Francisco in the tech industry, where there's lots of layoffs. So should we stay or should I go? So let's talk about the economy. Are we in a recession? Are we not? Let's talk about what that means in terms of the Fed's interest rates. I do think I will try to touch on the banking crisis. I'll use that term to start. And then we'll talk a little bit about interest rates, the debt ceiling, et cetera. So there's your quick outline. So are we in a recession? This is like waiting for Godot. We've been calling for a recession next quarter for 2 years now. Next quarter, there's going to be a recession, and it just hasn't happened. This morning, that 1.1 first quarter GDP, that bar you see there, was revised upwards to 1.3. Initial claims came out at 229,000, lower than an extremely low historic number, so you had a stronger economic growth, a continuing strong labor market, and in fact, the inflation PC indicator, which I'll show you in a few minutes, in the GDP report was 5%. That is not a recession. It's slow growth, it's really strong employment, and it's high inflation, but it's not a recession. And indeed, if you look at the box, when you look at the consensus estimate, not Ken Entenmann's opinion, not NBT Bank, not Goldman Sachs, the consensus estimate of all economic forecast is still calling for 1% growth for 2023 and 1.1% for 2024. What does that mean? We're not in recession yet. But it also means we have a razor-thin margin of error for going into recession. So if I was to argue, and I'll have a couple of slides here on housing, but I'll let you experts talk about it, but what we have seen is a recession in housing. Existing home sales absolutely collapsed in the last couple of years, largely driven by the chart on your top right, which is the fixed rate mortgage. So as of this morning, the national average for a 30-year fixed mortgage is over 7%. Now for me, and most of the people in this room, judging by the gray hair, 7% mortgage is pretty cool, right? But it's a sticker shock. So I have a son, I forget who was talking earlier, 31-year-old son, graduated from law school, married to a great young lady. She's a farmer rep. They have an 18-month-old kid living in a 2-bedroom apartment in a hot real estate market. They've been trying to buy a home for about 2 years now. My son says to me, Dad, I think I'm going to wait till mortgages go back to below 3%. I think he's going to be waiting a really long time. Because the thing and I think it does, it implies, it also extends out to commercial real estate and financing of real estate development projects, in that, look at that chart. Now, here I'm obviously talking about a 30-year fix, but it applies to interest rates in general. The abnormal thing is 3% mortgages. The normal thing is a 7% mortgage. So when you say, I'm going to wait to rates to go back to normal, they are. And I think it's important when we think about this going forward. On the bottom, we give you the price increases of the average home. So we talked about the average house here in Portland growing by 50% over the last several years. You can see it in the chart. You can see on the bottom right, the percent change year over year has been coming down, but it's still growing at 5% per annum. So the rate of change has come down from growing at 20%, but it's still growing at 5%. Why is that? Because Portland, like everywhere else, lacks supply. And throughout my presentation, we are going to be talking about supply, because most people, including the Federal Reserve, talk about demand. We're going to raise rates until we choke off the labor market. People are going to become unemployed. They're going to spend less money. That's going to cause a recession, and then we'll stop. That's a demand-focused approach. The problem that I see throughout our economy is we have supply constraints that I think have important considerations for housing. Again, housing inventory is low. We know that. Single-family home starts boomed in COVID, came down, but are still desperately needed. Multifamily housing starts have been pretty good. Next page on your right. One of the concerns that we'll talk about in a couple of seconds when I talk about banking is there's going to be a credit crunch, because banks are not going to lend as much money as they have before, and that's going to squelch off real estate. And the worry is, well, commercial real estate. Well, we have to define commercial real estate, because it's not all the same. And obviously here we're talking about housing, but when you look at commercial real estate, you can see this broken down in the chart on your right. Apartments, that orange line in the middle, are doing just fine. We're looking at vacancy rates. If you look at industrial rates, warehouses, shipping centers, truck stops, they're off the charts powerful. If you look at retail, struggling a little bit, but still up. And then you look at office space. And that's where the weakness is in office space. And I was just down at JP Morgan's conference last week, investment conference, and they had some real estate developers speaking. And one of the things I learned, and we talked about this a little bit last night at dinner, is converting an office into apartments isn't as easy as it sounds, right? Who wants to sign up for that condo in the middle of the office space with no windows, with your bed mantle up against the elevator shaft? Raise your hand. It's hard, right? And so it either requires a knockdown or some pretty heavy stuff. So it's not as easily said that, oh, we're going to just convert all this housing all this office space to housing. All right, so should I stay or should I go? If I'm looking at housing, the Fed should have stopped raising rates a long time ago. And it made my steam come out of my ears that when housing prices were going up 20%, the Fed was buying mortgages, keeping mortgages rates suppressed. Why? You had a booming market with prices up 20%, yet you were still stimulating the housing market through the quantitative easing process of buying mortgages. That was ridiculous. They should have stopped doing that years ago. So if I'm questioning the Fed, are we going into a recession? I look at the housing numbers, I'd say, well, we probably are. If not, we have already been. If I look at manufacturing, the chart on your left, this is the purchasing managers for manufacturing. It's at 47.8. It's an oscillator industry index. If it's above 50, things are growing. If it's below 50, things are contracting. It's 47. It's been below 50 for 6 months. There's already a manufacturing recession in the United States. If I go to the right side, while things have come down from the COVID peaks, that is the service sector, and that is still growing at a pretty healthy rate, around 52 on the index. So if I look at this, manufacturing tells me I'm in a recession. Should I stay or should I go? Services has been really strong. I don't know. What should I do? Really challenging. So the point is that the economic signals are very mixed. Further, if I'm Fed Chair Powell, I go and look at the labor market, and I see the unemployment rate of 3.5%. historically as low as it's ever been. That is as the title of the slide says, a strong labor market. This is my amateur photography of me driving by my gas station that I go to driving it to Syracuse, and they're reducing hours because they can't find staff. The sandwich shop in downtown Syracuse closing for a day because they can't find staff. It is constant everywhere we go. Truck drivers, help wanted signs, everywhere I see. How can we be going into a recession when there's help wanted signs everywhere you turn? So the labor market is strong, but I'm going to put an asterisk on that and come back to that in a second. And then the other problem Jay Powell has is inflation. So consumer price index 4.9, producer price index 2.3, PCE deflator at 4.6, jumped up to 5% today, moving in the opposite direction if you're hoping for rate cuts, and average hourly earnings going up. So some decent measures of inflation. The good news is it's trending down. So CPI has come down for 12 consecutive months. That's the good news. The bad news is it's 4.9%, nearly twice the level of the Fed's target of 2%. So that tells you the Fed has more room to go in terms of rates. So should I stay or should I go? It's really challenging. You have pockets of weakness throughout the economy, but not universal, right? You have a very strong employment market, very strong inflation, and then you had Silicon Valley Bank and the banking crisis occur starting in March. So I think it's really important for this group to understand what's going on here. And full disclosure, I work for a bank, right? Remember that? So this might be a little biased, I suppose, but we believe that this is grossly overstated and that Silicon Bank and Signature Bank, which are the two banks that failed, what we would call monoline banks or boutique banks. Signature Bank was catering to the cryptocurrency world, and Silicon Valley Bank was catering to venture capital. They looked nothing like NBT Bank, and they looked nothing like most of the community banks here in Portland. Nothing. So for example, good bankers diversify their portfolio. Diversification matters. You want a diversified deposit base so you're not subject to runs. You want a diversified loan portfolio. You want a diversified investment portfolio. Silicon Valley Bank, 80% of its deposits were over $800,000, above the FDIC limit. Anybody want to guess what the average checking account deposit is at NBT Bank? $18,000. So what does that mean? Silicon Valley, hot corporate money, NBT Bank, and just about every bank here, I'm using us as a proxy, mom and pop money. Which is more subject to a run? It's the hot money, right? You look at the loan portfolio. Over 80% of Silicon Valley Bank's loans went to the venture capital industry. At NBT Bank, 50% of our loans are consumer, 50% of our loans are commercial. When you look at our commercial portfolio, we have CRE, we have C&I, we have solar panels, we have a broad diversified portfolio. And then when you look at our investment portfolio, we have a very short duration, high quality portfolio. Silicon Valley Bank had a long duration, almost 100% treasury portfolio. And when you're buying 10-year treasuries at 1.6 and rates go to 4.6, that 300 basis point increase means about a 30% loss in your bond portfolio value. And then what happened was Silicon Valley said, geez, hey, the venture capitalist firms, we're your guys. We're going to raise $2.5 billion in capital, in equity, to kind of shore us up for this short hold so we don't have to take these losses on the bond portfolio. And the venture capital firm said, wow, you must be in trouble, we're out, and pulled all their money, and then told all their firms to pull all their money, and in 4 hours, Silicon Valley Bank lost $40 billion in deposits. My point is not to beat up on Silicon Valley, and it's not to promote MBT, but it's to say 99% of regional community banks look nothing like Silicon Valley Bank. So we do not believe there is a crisis. Is there liquidity? A crunch in liquidity? Perhaps. Is there a credit crisis? Absolutely not. Credit across the banking industry is as good as it's ever been. Our loan losses at NBT in 2022 were 0.07. Our CFO, Scott Kingsley, allows me to say I can round to 0, right? That's how good the credit quality is. So it's not a credit crunch like 2008. It was a liquidity crisis. And now I think, you know, and I have to be careful when I talk in these environments. So I called my CEO, John Watt, up and said, well, what do you see? So in the first quarter of this year, NBT increased our commercial loan book by over $100 million. So we're lending money. It's about a 5% annualized growth rate. So we're lending. Our deposits actually grew in the first quarter. So that's a sign of a healthy bank. And again, I'm not here to promote NBT, but that's what we're seeing in the marketplace, and it's true for just about every other regional bank in the country. So I do not believe there's a banking crisis. Why is that important? Is because the narrative is the banking crisis is going to further contract credit in the economy, and that's going to help slow the economy as well. And to some extent, I think that's true. I think the bigger thing that John Watt would say, and I would agree with, is just like my son waiting for 3% mortgages to come back, many of the real estate developers in this room over the last couple of years of free money have gotten extraordinarily generous structures to their loans and extraordinarily low rates. I think that's going to change, and I think so there's a sticker shock that I think is coming to the real estate industry that 3% mortgage my son's hoping for, that was the abnormal period, and the period of easy credit conditions and very low rates in the real estate development market was the abnormal period too. So in short, I think you're going to see the cost of capital go up, and that is something that you folks need to worry about. So what does this all mean? It's the end of free money. The Federal Reserve has raised rates 500 basis points in about 14 months. They raised rates, the first time was in March 16th of last year, and they're up to 500 basis points or 5%. This is a historic outlier. This is the fastest Fed rate hike increase in the history of the world. To put it in perspective, the last time we had a major Fed interest rate hike was in 2010. So we went to 0 in 2008 in the middle of the financial crisis. In 2010, the Fed started raising rates. They raised rates in 25 basis point increments over the course of 3.5 years and stopped at 3.25. They just did 500 basis points in 14 months. This is unprecedented, and it's part of the reason why the banking situation has become difficult. Now the question is really, should I stay or should I go? Are they done? I believe they are, for the reasons being that inflation is trending lower, so I think they get an out there. They can talk about the trend, at least if next Tuesday and Thursday's inflation numbers are in the right direction, right? And so inflation is trending lower. There will be a contraction of credit due to the banking crisis, and it's clear the economic numbers are slowing. So I think they have the ability come next month to say, we're calling a timeout, we're pausing, and we'll watch the data. That would be my prediction, but there's a 50-50 split on the Fed. And every language you hear from a Fed official is more rates, more rates, more rates, we got to squelch inflation. And I think in the short run, inflation will come down, will continue to come down. I am afraid it's going to remain more sticky. So what it's left us with is this really perverted yield curve where the front end of the yield curve is extremely high. The front end is being impacted by the debt ceiling discussions. But an inverted yield curve, so the blue curve is where we were at the end of 21, beginning of 22. That's a positively sloped yield curve, meaning long-term rates are higher than short rates. And the red curve is an inverted yield curve. What's important about an inverted yield curve? 9 of the last 6 recessions were preceded by an inverted yield curve. Everybody get the joke? 9 of 6. So every recession we've had in the last 50 years has been preceded by an inverted yield curve. But it's also given up a couple of false flags, right? But that's a concern that we have to have, and that's where we are. And you can see the spread of the 2-year to 10-year notes. So that is really a distorted picture. And it really makes banking really difficult, because if I'm taking deposits in at 5%, if our bank is going to retain our margin, maintain our margins, we have to be issuing loans at 8%. But we have people choking on 7% mortgages. So what's happening is bank margins are contracting, and there's a concern for that. So that's the interest rate thing. The next thing I want to talk about really quickly, of course, we talked about these and I'm almost out of time. So I talked about supply. I remain concerned, particularly for the real estate industry, that labor is going to remain a problem. COVID created a bunch of anomalies. One, we had a lot of people being paid not to work. Most of those benefits have expired, and we're slowly seeing them come back, but not quite as much. The proverbial kid playing video games in his parents' basement still kind of exists. We don't see those young workers coming. And more importantly, they're going to be 2-3 years behind the training curve, right? So we have a labor problem. So one was paying people not to work. Two was people retiring earlier than trend, as we call it in the economy world. And that's problematic because especially in a place like Maine where your demographics lean older. So National Electrical Contractors Association says the average age of a union electrician is over 50 years old. So as you guys start to do all your development, where are the electricians coming from? Especially in a period of time where we're expanding the electrification of the world in the name of global warming, right? So an article in the Wall Street Journal about Ithaca, Cornell, I'm familiar with it. It's a very environmentally sensitive place. Feels and looks a lot like Portland without the ocean. I have a nice lake, but not the ocean. But article in the Wall Street Journal of a gentleman trying to put a heat pump in his house and had to wait 14 months for the electrician to show up. And the electrician's saying, I'm booked out for 14 months, I'm running 6 trucks, more than I ever have, and I can't find any new electricians. That is a supply constraint that scares me on the labor front. On the commodity side, we are rapidly moving to expansion and climate change, and all of this billions and trillions of dollars are being spent towards climate change, which I'm all in favor of saving the world, but it is distorting a lot of the commodity markets. So for example, Germany has announced they're killing their last 3 nuclear power plants. They project they will be out of the coal-fired plant business by 2030. And they're replacing everything with wind, solar, natural gas that will then be converted to hydrogen in the next 30 years. It will require Germany's national electric grid to double in size in 7 years. Now, Freeport-McMoRan, one of the largest mining companies in the world, their CEO was on television the other day. He says that peak global copper production will occur in 2024, next year, peak. And it takes 10 years to develop a copper mine. So if Germany's going to double or triple the size of its electric grid, just like we will have to do here, where's all the copper coming from? And to talk about NIMBYism, we've talked about it in the context of home building. Try building a copper mine in Maine. I don't know that there's any copper in Maine, so I don't know if you want to. So in short, I'm very concerned long-term about inflation and commodity prices. Not so much in the next 3 months. I think inflation's coming down, but I'm concerned there. And then lastly, and I know I'm over time, so I got to get moving here. Debt and deficits, a number of people have asked me about it. So there's this political theater going on. Will we renew the debt ceiling? It's happened many, many times. We have never defaulted on our debt, and I think the base case should be that we will not default on our debt. But it does have interesting ramifications. The spending, I wish I had this chart here, but if you go back to the Kennedy administration and just track spending, it just goes straight up. And I color-code it by red and blue, Democrat, Republican. There is no evidence that anybody can show me that one party has the mantle of fiscal responsibility versus the other. If you look at government spending, it just goes straight up. And it will continue to go straight up. And the problem I have with the spending is this chart here, that pie chart. If you look at the maroonish, pinkish, mauvish colors, Social Security, Medicare, Medicaid, other mandatory programs, primarily pension plans, mandatory spending with mandatory COLA agreements is 63% of the government's budget. Anybody remember what the COLA increase is for Social Security this year? 8.7%. The top left, the light blue, net interest, 8%, has already grown to 10. If you include net interest payments, you're talking about 70% of the budget is on autopilot. Think about your budget at work for your next project, and think about if 70% of that was going at 8.7%. It's nearly impossible for the other 30 to get cut back in any reasonable way to make up for it. And so I get frustrated where politicians from both sides, so Donald Trump, don't touch Social Security. Joe Biden, don't touch Social Security. You are condemning people to a 23% cut in Social Security payments. That's not me, that's Congressional Budget Office. So the debt ceiling, I think, is political theater. At worst, I think they will suspend it and kick the can down the road for a week or a month until they get more negotiations. The headline coming into my presentation was the talks were intensifying. But at the end of the day, it's really hard to do. And if you look at that top right, the deficit, so this is the beginning of the year budget, the deficit was going to be $1 trillion. Today it's 1.7. So in the first 7 months of the government's fiscal year, the deficit has grown by $700 trillion, almost entirely due to higher interest rate costs, right? And the question I have for you rhetorically, long term, in terms of supply, is if the government keeps screwing around with this and they keep having this dysfunction, the natural reaction is people are not going to trust Treasury securities and yields are going to go up. And if that's the base of your capital is going to go up. And so I don't want to end on a horrible note because I do think the economy, especially here in Maine, is much stronger than the naysayers on TV. But longer term, I'm very concerned about the supply of labor. I'm concerned about the supply of commodities, and I'm concerned about not so much the supply of capital, but the cost of that capital, because I think it's going to go higher. And I am past my due date here, so I need to stop talking. Thank you very much. I look forward to being on the panel.